Welcome to the Millennial Money Canada podcast, a podcast to elevate your financial planning literacy so that you can live well, build wealth, give generously, and leave a legacy that you're proud of. I'm Guillaume, Girard, financial planner, and I'm joined by my co-host, Sam Lichtman, founder and financial planner of Millennial Wealth Advisors. And the topic of today is, why do you need insurance, and what are the key factors that would influence your need for insurance, if you need anything at all? The agenda is going to be broken down as the following. So there'll be a little crash course into the type of life insurance products that are available in Canada. We'll look at what's an approach to identify the needs where you would need life insurance depending on your situation. And then we'll look at different scenarios depending if you're in the accumulation stage or decumulation stage if you're approaching retirement. So in the accumulation stage, we'll look at, if you're single with no dependents, no debt. Once you meet someone, if you have spouses, if you have dependents, whether it's your kids or your parents, or if you have debt, mortgage debt, any others. And then we'll also look at a business owner scenario. And then in the decumulation stage, we'll look at, people who are approaching retirement or in retirement. Do they need insurance at all? What are the differences there? But before we dive into the topic of today, Sam, do you want to update the listeners on maybe a few initiatives that we've been doing around their financial reviews?
Yeah, for sure. So right now we're kind of running a promotion where we're offering free financial reviews for people who come from social media. And it's a 60-minute review and kind of go through high level all their financial, like the hot topic financial issues and things that they're looking to accomplish. And we've been doing that free since about Jan 15th. And I think we've booked something like 8 or 9 by now financial reviews since Jan 15th, just organically from social media. So that's been really cool just to see, our listeners. We've had some people come from the podcast as well, which I'm not sure if I shared with you, Guillaume, but we had some meetings over the last couple of days with people who said they've listened to our podcast and they found some value in it, and referencing our last couple episodes that we did with the executors and with what was the last one we did? Now it's blanking. Now I'm blanking on it.
Tax. We had the one with Mohammed.
The pension planning one.
The pension.
Like the options when you leave your employer. So yeah, it's been pretty cool to see kind of that happening. So I mean, we'll include a link in the description here if you guys want a financial review with our team and learn how we work long term with our clients. And that's been really cool to see develop over the last 2 weeks, because prior to that we've been using like paid ad strategies, and for one reason or another we've decided for now to stop the paid ad strategies and go organic and just kind of see what that works. And so far it's been working pretty well, so that's been really cool, and we've had a lot of people who've been really happy with the reviews they've gotten, and we're getting some new clients out of it as well. So that's a really cool new development that's happening on the business side.
Mm-hmm. Yeah, it's a great way for you guys as well to learn how we work with clients and whether we're a good fit for you. And if we're not a good fit for whatever reason, then you'll be left with at least some guidance as to what to improve, or where would be the areas of opportunities in your financial affairs, or the gap between where you are versus your goals, and what to address and what you could take on your own. So yeah, it's a great way for both of us to meet and then help you out, whether it's again during that meeting or for a long-term relationship.
And I think we've been having a lot of really positive feedback from doing the financial review up front, because people are finding value in the review, which is what we're trying to do, right? Like add value at every stage of the relationship with our clients. So whether it's like our first meeting or whether, we're meeting with a client 3 or 4 years, we want to make sure we're always trying to add value in those approaches. And so now we're at the place where, instantly they're getting a lot of value just from the financial review, and people have expressed like really positive feedback with that. So that's been a bit of a new initiative we're trying out, and we're not charging for it, whereas typically in the past we've charged for it, but we're not charging for it at this point in time. That might change in the future, but right now, until at least the end of January, and probably the first couple of weeks of February, we're going to offer that for free. So yeah, it's been a really cool initiative here. So I'm looking forward to meeting more people as well over the next few weeks.
That's awesome. Now I can hear your upbeat in your voice. Can you update the listeners on your health and how it's improving?
Yeah, well, I think because people may know that I got that like nasty flu that's going around and was like kicked me up for a week. And this morning, I woke up, my alarm went off at 6:15 and woke up and I was like, I could go to the gym again, because I've been trying to go to the gym every day during the week and Saturday as well. I could go to the gym again. or I can finally just like sleep in for a day and try to like really regain my rest and strength. And so I slept until like 8:30, which wasn't great because I had a meeting until at 9. So I kind of rushed to get ready for that, but slept until 8:30 and I feel great and feel like my energy's back. I still have a bit of a lingering cough, but in terms of like energy and just, I don't know, just try to be more upbeat, positive mindset coming back into it. Yeah, feels good.
Yeah, taking rest is so good. I try to take at least 1 or 2 days of almost complete rest of like activities. And usually what I do is I offset my hard working days at work versus my hard workout days. I try to have like one versus the other. So on Mondays it's gonna be like, a 10 to 12 hours of work, no workouts at all. Tuesday I usually do a double, Wednesday a double, Thursday kind of full rest again, just work. So I try to balance them out so that my energy level kind of stays consistent and I can go hard in all areas of my life essentially. So
yeah, that makes sense. I'm finding like with CrossFit, you don't get that same energy boost, or at least I don't get that same energy boost that I got from like running long distances. And so like if I'm running long distances in the morning, I feel like so energized for the day. But if I'm lifting weights, often it's like, oh man, I feel like fatigued and now I'm just tired for the rest of the day. I should adopt a little bit of that into like kind of like, hey, the days I, planning on lifting heavy, going hard in the gym, like, okay, maybe those are like light work days in terms of like no client meetings and we're just doing admin work and stuff. So yeah, that's an interesting way to approach it.
So you've signed up for a comp, right? In April?
Yeah. So I'm doing like an intermediate CrossFit competition in Aurelia, Ontario in April. So that's working. We're kind of building out like a 8-10 week training program right now. Which the first week we were starting to build it out, I got hit with the flu. So lost like 6-7 pounds or something like that. And I was just trying to get back to my baseline of where I was at before. Then we'll probably next week we'll start like training pretty heavily just for like the competition. So we've got like this kind of 8-week program where it's like training on strength for the first 2 weeks. And then week number 2, from week 2 to 4, we're training on like gymnastics and skill movements. And then from weeks like 3 to 5, we're training on endurance. So it kind of overlaps with itself. And yeah, so excited to get a little bit stronger, a little bit faster, a little bit more, I guess like flexible or something, whatever you want to call it on the gymnastics side. And I can almost do a muscle up. That's my next goal, is to be able to do a full muscle up. So I'm almost there. I can get like chest over the bar, but like I'm not quite at the hips yet. So that's the next goal.
Make sure you film it. Yeah. I filmed my first muscle up like when I started CrossFit. Like that was during the pandemic or after the pandemic, and after that, like you can see your improvements as well. But make sure you film at least the first one. That's something special,
Yeah. How's the High Rocks training coming?
It's good. I'm just running mostly right now. I'm still in the gym 3 days a week, but I'm prepping for a 10K in March 9, and then a half marathon in March 23rd. So this is I'm like laser focused on this right now on the running side. And I'm looking for big personal bests here.
Well, so you just did an 8K race, or was it a 5K race?
Yeah,
an
8K.
Yeah. So do you want to share kind of like how you did on that? Because you crushed it.
Yeah, that was good. It was hard. I mean, we're just starting the season right now, so I'm not supposed to be fast. And when I say fast, I mean fast for me. But like, yeah, it was actually really hard because 8K is very awkward. It's between 5 and 10. And what I mean by this is at 4 minute a K, like 5 is a really good push for me. So the last 3 was just like an absolute dogfight. It was, I had to dig deep and it was painful. It goes by fast. It was 32:24, I think, like exact time. But I was happy. I was hoping to be sub 32. But for now, where we're at, or at least where I'm at, I think it was great. I can't wait to see. Yeah, with some elevation-ish. I think it was over 100 meters. So it's not a whole lot when you compare to trail running, but when you're between 100 and 150 of elevation, a little hill like really requires you a lot of energy. Yeah. So it doesn't take a whole lot to like slow you down versus like a really nice flat road. The 10K is going to be rolling. So I don't really have a time yet, but it's going to be, like uphill first. And then the finish is going to be really fast because it's an out and back. So anyway, that's going to be interesting. And the half is also rolling like 150 meters of elevation. Yeah. So not flat, but like, over 21K,
So that'll catch up to you pretty quickly over 21K though.
yeah,
Yeah.
that's the thing. It
Yeah.
doesn't take, so I'm learning, it doesn't take a
Yeah.
whole lot to like require me a lot more energy to keep the same paces. And that's what I'm working on right now.
It's funny too, because the mental side of that, right? Like you see a small hill and then it automatically, you think that you're going to need to put so much energy to go into that hill. And then it feels like, I don't know, at least when I run, it feels like that the mental side of it is actually a little bit harder than the physical side. It's weird because if I'm running indoors on treadmills and we like change elevation, it's actually not that difficult for me. But if I'm outside and I'm running on elevation, it crushes me, man. Yeah. So,
I love running. Yeah. So,
yeah. Well, should we dive into our topic for today?
100%. Do you want to talk about my love for insurance?
Oh yeah. So funny story, right? Yeah, let's dive into that. I'll let you share kind of your side of this, but just for context. So I fly out to Victoria, or flew out to Victoria in March of 2024 or February of 2024 to meet Guillaume for the first time as we were starting to work together. And so I think we've shared the story of the hike up a mountain that was supposed to be just a hike and then ended up climbing a mountain in Victoria. And anyways, on the way up, I shared with Guillaume that and I guess this was news to you, that we do a lot of life insurance for clients. And it's funny because you should see the look on his face, because it was kind of like, oh my gosh, what did I just get myself into? But I'd love to hear from your perspective, kind of what your thoughts were then, and then kind of how that's evolved over the last year or so working together.
Yeah, I was, until I got my insurance license, and let's rewind here, because I've always been all my life in the investment side. Right from school, I went through the CFA route, and like I mentioned before in the podcast, like more of the institutional kind of portfolio management approaches, or at least from the market data side, but working with professional money managers. I've always been into that world. And I had little to no knowledge about the world of insurance. And this is on me, but I was looking down a lot on the industry as a whole because of all the things that are governing this industry, right? People, I would insist, all the agents are extremely knowledgeable about their products. I think it's very commission focused. Very few will be education based. So I feel there's a lot of, and this is a generalization on my end, but I just had a sense that everyone was there to out to make a commission. And I was looking down a lot on the products. But at the time, I didn't really understand them either, or at least which products were best suited for which situations. So it's only fast forward until I got insurance license. And then I started working actually with you, Sam, that now I have a much better understanding of, the products where they're best suited. I wouldn't say I am an insurance advocate, but I can see how, and we're going to cover this in this episode today, when there's specific needs and there's key factors that are influencing how much insurance you need. It's a wonderful product. It's something that you should look at. And of course, as part of every financial review or financial plan, we always look at, of course, the insurance needs or the gap there. And then we'll propose a solution that is best suited for the clients, at least from an objective point of view. And then we're going to walk you through that approach. Like, how do we do that? How do we come up with a framework where we would recommend you, hey, you should purchase X amount of life insurance, whether it's term or...
Yeah, I'm happy to see kind of like your evolution in this space as well. I think it started about, pretty resistant to it, but at least you were open-minded enough to like, hey, let's go through some of this stuff and figure it out. And at this point now, insurance becomes this concept where we can have these in-depth conversations about it with our clients across Canada and look at kind of both factors of where are you at risk, like where's your financial plan at risk, whether it's obviously, a life insurance side only pays out when someone dies, but like even a living benefits side, which we're not going to get into too much in this episode, but we're going to talk about in future episodes, like critical illness and disability insurance, like where's your financial plan at risk? And then where's your family at risk if you or someone else in your family were to pass away? And look at that as a potential need. And so there's obviously different situations and different preferences, and preferences can come into play here versus just like a strict needs-based approach. And I'm excited to dive into where that fits in with people and how we view insurance.
Yeah. I think one thing that is important, or one thing that I love how we are set up as far as financial planners and the different licenses that we have, is that we're truly objective in the sense that we have access to almost everything that is out there, whether it's the investment side or the insurance side. What I mean by this is if you meet with someone who only have one or the other, whether it's just investments or whether it's just insurance, by nature, they have to be biased into what their license or they're available to provide. With all this to say, when you work with someone who's holistic, like they will take everything in consideration and they will be able to come up with a solution that is best for your specific needs, right? And that's, I think that's key. Because in the insurance world, if that's all you can sell, that's what I had a problem with, is sometimes you put the cart before the horses. Like, I'm not sure what the expression is. Maybe I just butchered that. But, they're especially when you're looking at like whole life, everything looks like a nail with someone with a hammer. And whole life is great. And we're going to cover it. We're going to cover what it is. We're going to cover specific situations about it. But again, it's not the first thing that you should go about. It might be number 7 or 8 on the list of things that you should address as part of a comprehensive and well-constructed financial plan.
Yeah, exactly. And so kind of going back to the dual licensing side, obviously, it's impossible to be completely free of bias, right? We've got our own biases at play here, which we're trying to limit. But I think at the end of the day, having both licenses gives us the ability to be objective as possible when we're actually looking at a situation. But I think our approach is pretty aligned in the fact that we don't view insurance as a substitute for investment products. And I think a lot of the industry, whether they're dual licensed or not, views insurance as a substitute for investment products. And if you can come up with a compelling enough reason, you can pretty much sell anything, right? And so the way it's sold, we have some issues with, and the way it's marketed, we have some issues with. So what we try to do is approach it from like mostly a needs-based perspective, which we're going to get into in a little bit, and really walk clients through, okay, if you go this route, what is the likely outcome in 20 or 30 years versus going this route? What is the likely outcome in 20 or 30 years? We can do that and have a fair amount of expertise in both the insurance and investment side. We can really be objective in our recommendations with clients. And while Canada doesn't have a fiduciary standard to hold planners, advisors to, by our membership in the Financial Planning Association of Canada, we have taken a fiduciary oath that we will act in the best interests of our clients. And so we're working hard to raise and elevate that standard of advice in Canada as well with our roles in FPAC, or the Financial Planning Association of Canada. And my role specifically as political liaison, where we get to talk to politicians, attorney generals, and even in some cases in the past premiers about provincial regulations and potentially adopting stricter title protection and fiduciary standards across the country. So it's something we're very passionate about in terms of elevating the level of advice in our industry and not just making it sales-based, but we still got a long ways to go. So right now, the only thing we can do for our clients is be as objective as possible, take compensation out of the picture, and look at what is in the best interest of our clients going forward.
Yeah, that is so well said, especially around investment or insurance is not investments. And we're going to cover if you need insurance, and you need insurance in order to purchase insurance. If you want to invest, then there are other better solutions out there than insurance. Usually, for the most part, insurance should be it's almost like a sunk cost where you don't want it to happen. And that's a good segue into term versus permanent life insurance. So I'm going to cover term, Sam's going to cover permanent. We're just going to walk you through the differences. So term life insurance is when the coverage has a duration where it's a fixed period. It could be 10 years, 20 years, 30 years. The premiums, what you pay every month for that policy, is usually a lot lower compared to other life insurance products. There's no cash value that is accumulating in the policy. So when you pay your premiums, there's not a portion that is being accumulated on the side for you to access. You just pay your premium, and if you happen to die within that period, then the death benefit is going to be paid to your beneficiary or your estate. Mm-hmm. The purpose is usually around a temporary needs. Could be replacing, an income for a period of time, but maybe you have dependents, so until your kids are 20 years old, or if you have a mortgage until the mortgage amortization is paid off or is completed, or any other temporary needs that you may have. And then at the end of the coverage, so let's say 20 years, you've paid all your premiums, and you're still alive, which is great news, then the policy just expires worthless. So it was a lost, lost cause here, like a lost opportunity in terms of like your investment. And that's the purpose of it. The purpose is not that you actually cash it out, you want to outlive your term life insurance policy. What about permanent life insurance?
Yeah, that's a great explanation of term life insurance. And I always like to say, like, if you can think about the names, term is for temporary needs, permanent is for permanent needs, right? And so an example of some permanent needs could be a need for liquidity at death. If you have a bunch of money in fixed assets, real estate, things like that, you may need some cash available to pay a tax bill at death. So that could be a need. You could be looking at something along the lines of a corporation where you potentially are going to pay 66% tax on death, and an insurance policy can implement part of a more comprehensive financial plan. It can be a part of that. You can use insurance shares to essentially help with an end estate bill and things like that, which we're not going to get too into. At some point in here, we'll have our insurance specialist, who's a tax lawyer, come on and kind of go a little bit more in depth on this. But there's some different opportunities available for permanent insurance within a corporation. Personally, the needs are pretty limited to basically needing liquidity on death, or if you have like a large non-registered portfolio and you want to set aside some of the non-registered portfolio and buy permanent life insurance instead, you can do that. The effectiveness of it is arguable, but you get to add a beneficiary onto the permanent life insurance policy. You get some safety within the cash value side of the insurance policy. And so there's some arguments there to be made. If we want to go high level, so permanent life insurance will guarantee a death benefit at a certain point in time in your life, whenever you die. So whereas term expires after a period of time, permanent doesn't. And so if you die at 60 and you buy a policy at 30, the permanent insurance will pay out. If you die at 70, 80, 90, or life expectancy, right, the insurance policy will pay out. So it's a guaranteed coverage. The way the premiums are handled is you can pay for it for 10 years, 20 years, 30 years, or all the way up until you pass away. So there's kind of like life pay, and there's like 10 pay, 20 pay, and those are the most common types of insurance. Choose the 10 pay option, then you basically pay for the policy for 10 years, and then you own the coverage forever. Now, there's still a net cost of insurance, right? It's not like you've necessarily prepaid for all the insurance, but that net cost of insurance in permanent and whole life insurance comes out of the cash value, and the growth rate on the policy is going to be likely more than the cost to own the life insurance. The cash value continues accumulating even while you're still paying for insurance from the cash value portion. So that's typically, it's just kind of like a bundled in product with permanent whole life insurance. As well, whole life insurance has another name. It's like participating life insurance. And so I won't get too technical because there's a bunch of different types. Sorry, go ahead.
No, yeah. So just a key thing to clarify here as far as the cash value itself. So one of the big difference with the permanent life insurance is when you pay your premiums, there is, because it's a lifetime coverage, meaning that you're guaranteed to be paid at that, your premium is going to be a lot higher. And then, like Sam mentioned, depending on how it's structured, when you pay your premiums, there's a portion that will be allocated, so to speak, to the cash value. And that's what we mean by it will build a cash value over time. So you're paying your premium to maintain the policy in force, but then you will have a cash value, an account basically that will grow on the side. And that account can be accessed for various reasons. We're not going to cover this today. We're just walking you through the differences between life and permanent, but we should have a definite episode on permanent itself. Why you would want to prefer something with a cash value? What can you do with a cash value? What are the tax consequences when accessing the cash value and all that stuff? But at a high level, that's what you should know. Yeah. And that is really important.
Yeah, for sure. And so it's important to understand as well that like not every permanent insurance has cash value. Like you can get non-participating full life insurance and you can get term to 100 life insurance. So it's important to know the type of insurance that you're getting. But typically the way it's sold is like, hey, here's a permanent life insurance policy and here's an investment component to it as well. And it's all bundled into one. And the reason why whole life is sometimes called participating life insurance is because let's like assume your premium's $1,000 a month. Let's assume this isn't actually how it works, but let's assume like 500 goes into the cash value, 500 goes to pay for the insurance. The 500 that goes into the cash value participates in the growth of the insurance company. So the dividends that it receives, the $500 cash value, will accumulate in respect to the growth of the company. Now, it's not like a stock dividend you'd receive where the policy is necessarily set by a board of directors and it's from your profits of the company. Really what it is it's an accumulation of premiums paid by the policyholders into the participating fund. And then any overage amounts that are required, that basically they pay into it, are then redistributed back to the par policyholders as dividends. So it's not a real dividend, but they call it dividends. Essentially, one person put it quite well, where it's basically like dividends in a whole life insurance policy are essentially just an acknowledgement that they're overcharging for the premium and repaying that into the cash value. Now, it's again a bit of an oversimplified way of looking at it, but essentially you have to understand those dividends come from the premiums paid by all the participating policyholders. It's not like you're getting a chunk of the after-tax profit of the insurance company itself. So we have to differentiate those two things, even though they're both called dividends. With participating life insurance, participating whole life is a little bit different than the other type of permanent life insurance, which is universal life insurance. Because in a participating whole life policy, you don't get to choose the underlying investments in the cash value. It's basically the growth is dependent on the insurance company itself. Versus a universal life insurance policy, it's separated into two components. There's the base cost of insurance, and then there is the cash value component. And the cash value component, you can actually have control over the investments in there. And you can choose different funds, right? US equity, Canadian equity, those types of things. We're not going to go too deep down this rabbit hole, but essentially what happens most of the time is you can either get level premium. So basically the insurance part, you can either have level cost of the insurance, or you can have yearly renewable terms. So every year the cost of insurance, so you buy $500,000 of universal life insurance, every single year that $500,000 will get more expensive. And so that's a very common type that's sold, yearly renewable term. And you're going to fund the life insurance, plus you're going to fund the cash value. And the illustrations will show you where, based on a percentage rate of return and the cash value, when you can stop funding the policy, and the cash value should take care of the rising cost of insurance. We have to be very careful with these, but that's kind of in a nutshell universal life insurance, whereas permanent life insurance, participating life insurance, you think about more like defined benefit pension plan in that context, where the risk is more so on the insurance company to make sure that the policy dividends are continuing to grow to fund the cash value or to fund the life insurance. Universal life, the risk is on you, the investor, to make good investment decisions with the underlying cash value fund to make sure that it's still suitable for and going to continue paying those premiums after you've stopped paying.
Yeah. So, and when you said level, what you mean by this is that it will going to be the same payment year after year. It will going to be stable versus yearly renewable. Then you might see fluctuations in how much you're paying to keep that policy in force. Do you want to talk about one scenario that you came across and how it was structured with a yearly renewable insurance, but the policy was about to lapse quite early?
So often universal life insurance policies are sold by agents who don't have a lot of training in this space. And so there's very high commissions that are paid out to agents on this. And then there's high commissions paid for the cash deposits as well. You have to be very, very careful with universal life insurance. We came across a situation where there was a policy that was set up by an inexperienced agent. A business owner was contributing close to six figures into this policy. And the agent had put a rate of return expectation on the cash value of 8%, which then would show the business owner would stop funding this policy at age 60. And the problem with that was that 8% is an unrealistic expectation of returns to place on a policy illustration, especially considering that the underlying funds they were invested in had 3% fees every year. So in essence, that would mean that the actual underlying funds would have to do 11% gross in order for the 8% to actually work. But that's assuming that it gets 11% every year and that there's no variations in that. So obviously, if the stock market has a bad year, the fund itself could drop 10%, right? So that is that policy itself, we ran it through a bit of a stress test and found that it would lapse by about age 65 if they actually stopped paying for it by age 60 based on likely outcomes. And so those are some issues we've run into quite frequently when looking at these universal life insurance policies. They kind of are sold as an insured retirement plan where you can get insurance and a retirement plan all baked into one. Be very, very careful when you hear concepts like that. It oversimplifies the product and it is more of a sales concept than it is a financial planning concept.
Yeah. Okay. So I just want to summarize and then I'm going to ask you a question based on your experience here. I want to summarize what we covered on the permanent life insurance so whole life insurance. Depending on how it's structured, it can be, again, level premiums over time. Your cash value is guaranteed. So whenever you're reaching a new level on your cash value growth, based on the dividends that you may receive, if it's structured as a participating policy, you will receive policy dividends, which will continue to grow and grow your cash value. So this is great for people who are more conservatives or want something that is more predictable or stable. There's no market risk there. And of course, if you need lifetime coverage while paying fixed payment, whether it's a 10-pay, 20-pay, or a life pay, like Sam mentioned, depending on how it's structured. The cons is that it's going to be more expensive than other types of insurance. There's technically less flexibility, I guess, in paying the premiums versus others, like something like a universal, but that can be debatable. Yeah, and then I guess lower cash value growth potential, I guess, compared to maybe a universal life because they're taking market risk with the cash value. But again, that's also quite debatable. So the universal life insurance, what's kind of Sam mentioned, so the premiums can be adjustable, where in this case, basically the policy might lapse if they stop paying the premium or they deplete the cash value within the time frame. They basically would lose their coverage, and that was quite early. I remember, I think the case was a 70 in the 70 or 80, which is way beyond.
Yeah, it was like 7 years after they retired. So I think it was like 67.
That's crazy. So that's way too early versus their life expectancy, right? Yeah. So universal life insurance cash value is usually attached to market-based growth, depending on how it's invested. And then the death benefit can be adjusted as well. Can you talk about, like, I've never done universal life. Can you talk about a scenario where universal life would be more suited? Or do you think it's just a garbage products all around?
Okay, so universal life insurance is very, very niche. Like most people, first of all, most people don't need permanent insurance. And then most people who need permanent insurance should stay away from universal life because, generalizing here, insurance is supposed to be a risk management tool, and universal life doesn't actually manage risk because the underlying investment component is potentially likely all in stocks, and you as the investor are taking on the risk of that. So that's one area to consider. Universal life can be a useful tool if you need permanent life insurance coverage and you don't want to pay a lot for it, because essentially you can just buy a yearly renewable term and just not contribute anything to the cash value component of it, and then basically just fund the insurance premium side. Now, it's still going to be cheaper than like a term 20 or a term 30 because you're going to be, or more expensive, sorry, because you're going to be paying for it over long periods of time. In terms of the cash value component of it, it's tough for me to think of scenarios. And again, like, I'm not an insurance expert, but I haven't really come across a scenario. And I work with business owners, executives, high earning millennials, people who've got millions of dollars in corporate cash portfolios, and people who are earning up to millions of dollars a year. I haven't seen a scenario where universal life makes more sense than whole life. So I'm sure those scenarios exist, but I haven't seen one in specific.
And would you agree with the framework where if someone is mistaken insurance for investments and they're usually going towards the universal life because of the appeal of the market-based growth, would you agree with the framework where they would be better off investing outside an insurance policy entirely, which would be, into a globally diversified portfolio of, almost 100% equities or close to it type of thing in order to grow their wealth?
Excuse me. Sorry, we can cut that out. So when you come to the comparison of investing versus insurance should not be a substitute for investments, because when you look at the likely growth in an insurance policy, when you look at the likely growth inside of an insurance policy, specifically whole life, right? You're looking at 6%, expected reinvested dividends on the cash value. You're going to lose to an all equity portfolio, even after tax. You're going to lose to an all equity portfolio over a long period of time. The returns are just more conservative. And even when you're looking at, okay, well, what if I invest in an equity portfolio inside of a universal life insurance product? Well, even the index funds inside of universal life insurance products have fees somewhere up to 1% to 2% or higher. And so even if you just look at the difference in returns that can bring to the table, investing in an index fund portfolio that's all equities outside of an insurance policy will likely crush an insurance policy underlying investments. So there should be alternative reasons to buying the life insurance policy outside of just the investment component, because if you're a high risk investor who has 20, 30 years before they need access to capital, you're going to do much better in terms of just higher net worth by investing in index funds likely than you would be in a insurance policy investment.
Yeah. I think the takeaway as well is the more risk you can take on the investment side personally or within your corporation, but I mean, outside of life insurance policy, the more equities you can hold, the worse your life insurance policy is going to look versus the portfolio that you'll accumulate. But the more risk averse you are, so if you're a conservative investor, and we've modeled that, that's why I'm saying this, we've modeled out different asset allocations to see like where the break-evens were. But the lower the risk you have in your investment portfolio, the better the permanent insurance will look in comparison. But again, the longer you expect to live, the worse the life insurance product is going to look like as well. Because life insurance has amazing returns if you die early. The best time to buy insurance is the day before you die, right? And then you have 1,000% return on your investment. So,
yeah.
Okay, let's move on to insurance analysis framework here. So there's basically two approaches that is well used in the industry, and I have my opinions on the second one, which is pretty heavy. But the first one is called the needs analysis approach. So what does the needs analysis approach entails is that you look at how much do you need today, how much do you have in assets, and then what's the gap. So how much do you have today, how much you need, how much do you have, and then what is the gap that you should insure. So by looking at your total needs today, you can look at your immediate expenses, can be funeral costs, debts, legal fees, ongoing living expenses. So the mortgage, rent, utility, daily living costs of the surviving spouse. You can look also at future financial goals. So if your children are, let's say, between 5 and 10 years old, and you want to have insurance in place until like they get to 20 or 25 to pay for their education, you can look at like the future needs, bringing back this to today. What is the value of that? As well as maybe your spouse's retirement. If you pass away and she survives you, like what would be the expected living expenses throughout her retirement? And you can bring that back to today. So those are the needs. And then you can look at the existing assets that you have. So how much saving, investments, pensions, and other sources of income that you can expect to have. You bring this back to the present value. And then the difference between both will usually dictate what is at risk here. And this is one way to determine how much life insurance coverage you should get. So for example, if you have immediate expenses of about $500,000, the present value of your ongoing living expenses for the surviving spouse is another $500,000. The future financial goals, so your spouse's retirement, the present value of that is like $1 million. And then your existing assets today are worth $500,000. So your total needs are $2 million. Your existing assets are $500,000. Then you would technically need to purchase $1.5 million in life in coverage. And then that usually can be at least explored initially in terms of term. Okay, what is going to be the period where you actually need that coverage? And is that need going down over time? And when is it going to go down?
That's a great explanation of needs-based coverage, which is the approach that most people should be taking when it comes to identifying life insurance needs. Even within that framework that you just mentioned, people will have their differences of opinions on what qualifies as a need versus a preference. And so we have some people, and we always tell people there's no right or wrong answer here when going through the insurance assessment. But, do you cover off your partner's retirement if something were to happen to you, assuming that, kind of all of these other factors are at play? And some people say yes, some people say no. It's like, do you want to have income replacement, or like, do you want to cover off your kids' education? Do we want to set aside some money for that? Some people say yes, some people say no. And then we look at, okay, what about future cars? What about future expenses, things like that? How do you want to have that covered? And so often it becomes a very personalized conversation. And so when we talk about like the need for every individual is going to be different. And some of that kind of, we dissect the need here. If the need is 2 million, $1 million of that would be an actual need, potentially cover off debt, liabilities, things like that. And then another $1 million might be the preference that they would have to leave their partner financially comfortable if something were to happen to them. So that I think that breaks it down well. And that's the approach we use.
That's so well said. That ultimately all those points, or like you said, needs, are ultimately all preferences, depending on, again, your wishes and what's important for you.
Yeah,
right.
Exactly.
Yeah, 100%. Okay. Now, the second approach, which I have a very hard time with, very, very hard time, it's the income replacement approach. And this is it's a lot simpler. There's a lot less calculation. It's more of a rule of thumb, but it's basically, and I'll explain the formula, and then after I'll tell you why I think it's sometimes misguided to use it. But basically, your life insurance needs would be calculated as follows. You would look at your annual income and you would times this by the number of years until retirement, or you would times this by a certain, a certain number, whether it's times 10 or times 15. And I want to hear your opinion on this, but I think the reason why this was used as a technique is because they might be assuming that, let's say someone earns $100,000, they're basically spending it. So if they insure themselves, let's say until retirement, or let's say for a certain multiplier, that would give them enough insurance coverage. What's your opinion around the thought process around using an income replacement approach?
So I actually think that income replacement can come in handy for topics like for different types of needs identified. So for example, if we're looking at income replacement for the first 6 years of a child's life for one partner who passes away, well, the other partner is going to then have to potentially stay at home or hire or send kids off to daycare, right? And all of a sudden we're looking at a dual income household that's gone down to a zero income household, and we want to look at income replacement for that period of time. We can use that approach for that. But there's instances where I think like income replacement can be utilized. In some cases, we've actually had it where people have wanted to insure their after-tax income up until their partner retires. And so basically looking at saying like, okay, I make $100,000 a year. I want to make sure that if something happens to me, we had this whole life planned out. I want to make sure that at least my income is going to be replaced over that 18-year period, so that my wife never has to go back to work if she doesn't want to, or my partner never has to go back to work, or they're never going to need for anything, and that they have the ability to still contribute as if there were two people. Now, whether or not that is a approach that should be taken, I think that we have to be careful about saying like so we have to be careful about saying like someone's preference is wrong here. But as a rule of thumb, when we're looking at this type of policy analysis or this type of needs analysis, you should be incorporating needs-based approach into it. And then if there's certain factors within their life that require an income replacement approach, you can fit it in versus just taking a one approach or the other. If you're going to do that, you do needs-based. You're not going to just do a standalone income replacement. That doesn't make much sense. And even regulators have moved towards requiring agents to say that they are implementing, and insurance companies are doing this too, implement a needs-based sales approach, right? And so you're going to get audited at some point. We're going to get audited as insurance agents at some point, where they're going to ask us, show us your needs analysis for these specific policies. Look, if we don't have anything to back that up, then we could get in some trouble. So it should be the approach taken first, and where I think income replacement can come in just as like a feature within the needs-based approach, if that makes sense.
Yeah, that's so well said. I think the reason why I had like a little bit of a hard time with this concept is because I think there's a big discrepancy between like income and expenses. And I just saw income as almost like irrelevant in a way where if someone, for example, makes $200,000 a year, but lives on 50, well, their income really is almost irrelevant. Now, if you look at like their expenses and their expected expenses as well, so throughout their lifetime, and then maybe some savings as well, like you would want to look at like, a lot more detail than just taking the income. I just think sometimes the income can be misguided or can like massively inflate the true need of insurance, which of course, that's why you said like looking at a needs analysis. I think it's all this to say that this is a rule of thumb. I think it may overestimate or underestimate, like you said, in some cases, and it's definitely not specific enough. So if someone presents you a proposal just based on that, I would be very skeptical of that like number. Again, unless they've done like a thorough analysis here.
It's interesting too, because like in both of these approaches, people are then going to pitch you like different type of insurance that they think you need. So like they're going to say, okay, well, we did a needs-based approach, and now, you need, let's say, 1 million of term and 500,000 of permanent insurance. right? And they'll try to fit in different products to meet that total need. And so this is where you have to be careful as well, because if we're looking at, a needs-based approach where, listen, you're on track to accumulating wealth personally, you're both employed, you and your partner are employed or whatever. And by age 60, you'll have $2 or $3 million in assets. If you continue accumulating this way, should you buy permanent insurance, right? As part of your need? Because do you need $500,000 of permanent insurance throughout retirement? The answer most of the time is you don't know, you don't need it. But then we got to look at the alternative factors of, okay, well, what could it do for you? And would that be preferable? Because so there's some really critical insight and thinking that needs to be done around if you're getting pitched a permanent product and there's not really a lot of complication to your situation, and you've got a lot of liquidity and you're being pitched a permanent product as part of your holistic solution, even if you can afford it, right? We want to look at the utility of it, what it's actually going to provide you, or was it going to help you accomplish certain goals like estate planning goals, right? So it's going to be more than just, it's got to be more than just an advisor saying, yeah, well, it's probably a good idea to make some of this permanent just so that you have some permanent insurance coverage over the long term. There's got to be more insight. It's got to actually accomplish something for you better. And it's got to accomplish it better than an alternative. Because I believe it's Harold Geller, who's a lawyer who works with client complaints against advisors. Basically, he says, as soon as, I believe it was him, that I could be misquoting him, but as soon as you add an investment component into insurance, it must be compared against alternative investment options, right? And as soon as that happens, you need to all of a sudden say, okay, this is no longer just insurance. Now we're looking at an investment component. So what are our alternative approaches to investments here? And then how do we rank this in terms of our alternatives and my risk tolerance and what do I want to accomplish? So we've got to make sure that that is first and foremost how we approach things.
Love that. Perfect. So now let's dive into the scenarios. So there's 4 scenarios that I'm going to ask you about and we will chat. For each scenario, I'm just going to describe it at a high level. And there's 2 things that I want to leave the listeners with. One is, in this scenario, why would they need insurance? And then second, what are the factors influencing the amount of life insurance they would need to purchase? The goal is not to tell you exactly you need to go and buy this, because we don't know you. We already mentioned, we need to do a needs analysis. We need to look at all areas of your life. We need to have a deep conversation about what's important, what are your values, what are your goals, and then we can come up with a gap or something that is at risk here. But for this episode, I want to go through 4 different scenarios where we'll walk you through them and then leave the listeners with some insights as to what they should think about, why, depending on where they're at in their life, and then the factors that they should consider. Okay? Cool. Scenario 1, today, where I'm 30 years old, single, I'm working in a full-time job, or I'm starting my own business. I might be thinking of buying a home in the future, and I'm hoping to meet someone and potentially have a family, but I'm not sure about the timeline. Why would I need insurance?
So at this point, you probably wouldn't need insurance, but obviously, we'd probably want to dive in a little bit deeper into their situation. When we're talking insurance, I'm so specifically talking about life insurance. So, do they need life insurance at this point? No. And so then we can get into the conversation of, okay, well, are you buying a house in a month or 2 months, or are we talking 2 or 3 years down the line? Are you in a situation where you want to insure your health by getting a really cheap policy that you can convert later on or something like that? We can have those conversations. But at the same time, in my opinion, life insurance at this point in time for this individual, the only reason why it would be suitable or could be suitable, and I think this would be a bit of a stretch, would be to say, well, I know I'm going to need insurance in 5 years and I know it's going to be cheaper to buy it now, or I don't know what my health's going to look like in 5 years, so I'm going to buy it now. Right? So those would be really the only 2 scenarios you could kind of float around there, assuming that it's kind of like an average scenario where the person doesn't have a super complex business, financial situation, business partners, those types of things. If it's just hey, solopreneur or full-time employee, just building up wealth the traditional way, RSPs, DFSAs, yeah, it'd be it'd be a big stretch to say that person needs life insurance. Okay. What about you? What do you think?
I agree 100% with everything that you just said. So to summarize, there's no need really, but someone could guarantee their insurability if they wanted to. question for you. How would you go about determining the amount based on, I guess, an expected future mortgage or future liability?
Yeah.
How would you go about that?
Yeah, so it would probably be based on like sometimes we do this for people that are starting their families and let's say they have a mortgage, they have an existing insurance need, and then the conversation becomes like, okay, well, you want to start a family. So at that point in time, it's a little bit easier because we kind of know that that cost is or that insurance is going to remain fixed when the child gets there. It's not like, oh, we have a child and all of a sudden our initial calculations are way off from what we thought we'd need a year ago. So that becomes a little bit easier of something to predict where it's like, okay, we know that we want income replacement if one of us were to pass away for at least 6 years, potentially more. So that factors in. We know we want to fund our ESPs if one of us passes away. So that factors in. So we can kind of calculate that regardless of where they are at in life. But the other thing, and then if we do that, and then for some reason they don't have kids, then we can just cancel the policy, right? And so that becomes a bit of, you go with a cheap term 10 or something like that, or, and so it's a minimal cost to them. And then, we can convert it into a longer term later. So that's something we can look at. The other needs though, like, hey, I might buy a rental property in 2 years. I want to insure the mortgage, or I might buy primary residence in 2 years. That becomes a little bit harder. You kind of have to come up with like, okay, what do you expect to be able to buy? And then that number likely will change over time too. So you probably want to err on the side of a little bit more versus a little bit less, because you can always decrease the amount of insurance that you buy without going through health questioning. But if you want to increase it, then you've got to go through health underwriting again. And we've had situations where healthy 30-year-olds have had heart attacks and all of a sudden they're uninsurable, right? So that's where you kind of want to, you're doing it less of as an analyst in that scenario and more peace of mind, right? Like in saying like, okay, well, you're a high earner. You can afford a cheap policy right now to insure your future liabilities or yourself or guarantee your insurability. So maybe we err on the side of $1 million instead of 500,000. Maybe we're on the side of 2 million instead of 1.5. And that way, if you need to decrease it, you can, but you probably won't have to increase this amount.
Yeah, I like that. Okay. So if you want to guarantee your insurability, you can, again, you may be shooting from the hips a little bit because that's what you're trying to do. You're trying to be proactive into buying in life insurance based on a debt that you don't even have yet. So that's where the trade-off is. So go for the higher amount. And then if you end up purchasing something that is cheaper, then it's easier to decrease it than having to reapply to be able to increase it. So,
yeah, exactly.
Okay. Makes sense. All right. Scenario 2, fast forward 10 years. So now I am 40 years old. I've met someone. I have 2 kids between the age of 5 and 10. So just after my 30th, a year after my 30th,
Yeah.
I met someone, got 1 kid, and we're 10 years later, and he's 10. So we're moving fast out here. So 10 years later, I'm 40 years old. I have 2 kids between 5 and 10, a mortgage, no debt outside of that. What is the need of insurance at that point?
So I think this insurance need can come in 2 components. So we've got the debt side of things where, okay, let's say, you guys have this lifestyle now and you don't want to have to sell the house if something happens to you or your partner. So depending on if you're dual income, we'd have to figure that out, dual income household or single income household. If your partner could not afford the mortgage on their own, then you would likely want to pay off the mortgage if something were to happen to you. So that's number one. And that's a very common request that clients have is, okay, if something happens to me, I want to pay off the mortgage for my partner so that they don't have to sell the house or potentially like go back to work right away or something like that. So that's one aspect of it. And then the next aspect of it is looking at kind of, you mentioned this in your needs analysis, your needs-based approach, where we're looking, okay, what assets do they have? What does their retirement goal look like? And what's the difference in between being able to hit their goals and their current net worth? What's their potential income replacement need? I know you don't like this, but what's their income replacement need potentially for their partner if they're a stay-at-home parent versus if they're working? What are their likely household expenses after the mortgage is paid off? And if the partner is stay-at-home, then we want to make sure that the deceased partner's income is being replaced up to the ability to still afford to live, send the kids to after-school programs, sports, contribute to their RESPs, things like that. So we want to factor that into the equation. And if retirement becomes something that you both want to fund, if something happens to either of you, then you can leave behind a death benefit for the present value of what they would need for their retirement at age 65. So I think those would be some approaches. I think this family likely needs insurance. Obviously, it depends on what their assets look like. It depends on their liquidity of their assets. If they've already accumulated or won the lottery of $5 million or something, they probably don't need insurance. But if if you're the typical family, you've got a mortgage, you've got a house, you're saving some TFSAs and RSPs, you don't want to have to liquidate those if something happens to your partner, then insurance is suitable here.
Yeah. I would add one thing to this is exactly what you mentioned around if you want to replace the spouse's income for that period of time to be, I guess, loose, or, you can start with that. Or you can, like I mentioned, I think already previously, you could look at like, okay, what are the expenses that would need to cover? What are the savings that would need to be made to be able to grow those amounts to be able to fund the surviving spouse during their retirement? So anywhere between that would be more the conservative route of how much insurance would be needed, and the more aggressive route would be just taking their income. But again, depending on how high the gap is there. But yeah, I think that's you summarized really well. So mortgage is pretty explicit, and maybe any other wishes they may have. Schools, kids' education might be pretty explicit, and then estimating against the surviving spouse retirement income needs, essentially. So
yeah, exactly.
Yeah. Okay. Cool. Fast forward another 10 years. So now I'm 50 years old. I am I'm 50 years old. My wife is really successful in her business. I'm actually a stay-at-home dad. I have one kid that is 20 now. He's independent, but I still have one kid at home. Still have mortgage debt. Yeah.
So this is a different person.
Let's just
okay, so you had two kids 10 years ago. You've got one kid now. So I mean, I hope as long as nothing tragic happened. All right.
What would be the insurance need for either someone who's a stay-at-home and versus someone who's working as a business owner, as an incorporated business owner?
Well, yeah. So I mean, the questions would have to come in here to determine this a little bit better. So does your wife have a partner in her business, or is it just her?
Let's just say it's just her for now.
Just her. Okay. And is she making $250,000 a year in her business, or is she paying herself $250,000 a year?
Let's say she's paying herself $250,000.
Okay, what's she making?
Let's just say $500,000.
Okay, and so she's saving roughly about $200,000 in the business. Let's say $150,000 a year in the business. Is that fair to say? Okay,
sure.
Are you guys fairly do you still have a mortgage? So you still have a mortgage here?
Yeah.
And when is the mortgage scheduled to be paid off?
We're about 5 years away.
5 years away. Okay, so a small mortgage is going to be paid off in 5 years. Do you have pretty good investments outside of the corporation?
Yes, we're about, let's say, just shy of $1 million.
Shy of $1 million. Okay, so, and then with the ability to save like $150,000 a year in your wife's corporation, I mean, if you want to retire in 10 years, then you should be pretty well set. And does she plan on selling her business, or does she plan on just keeping it as winding it down when she retires?
I think she might be, that's a good question. I think she might just be winding it down. I don't think she's gonna be able to sell it because there's no real value into it.
Just like a service business, like everything runs through her. Yeah. Okay.
Like it was like a coaching, like it was her essentially, unless she trains coaches and then kind of sells it. But let's say for now, she's just gonna close shop essentially within the next decade.
Okay. And do you have a lot of money in RRSPs, or is it pretty well kind of split between TFSAs and RRSPs?
They're both
maxed out. Okay.
Yeah.
So I think in this scenario, the insurance need would be more focused around any gaps in your ability to retire in 10 years versus where you are today. And I would say that the insurance need would probably be fairly low at this point in time, because if you already have $1 million saved and something happens to you, your wife still has the ability to go back and work and make sure that there's money coming in. She's a primary income earner in the household. Now, if something happened to her, you have $1 million saved up. If you're staying at home, taking care of the child still at home. This is where preference comes in. If you wanted to still wait, because let's say that child is at what age now? 10 years old?
15.
So let's say, okay, even 3 more years, you're like, okay, well, I'm just going to wait till they're going off to college and then I'll go back to work, then you potentially don't even need to access the capital. But if you want to have some coverage until they go off to college, until you're ready to go back to work full time, then that's where you can build in some, replacement of your partner's income into the equation to kind of cover off that gap. But because you've already got high liquid assets, which should be enough for you to be able to retire at 60, then the difference just becomes, okay, well, what about age 50 to 60? Are you going to need to touch those assets now? And then we probably have to do a retirement analysis, like what is it going to cost you to retire? What's your CPP eligibility? What are those types of things look like to make sure that you're able to fund your retirement? Should you decide to go back to work or should you not decide to go back to work? So that's where it becomes a bit of a preference. The mortgage side, I mean, if you want to do like, you could insure the mortgage for another 5 years. I think there's some 5-year term policy, so we can go ahead with that. But realistically, that's not a huge need. It more becomes like the difference, I think, where you're at right now versus where you need to get to hit retirement. And the primary insurance would be owned by your partner, not you, like in terms of the larger amount. Your insurance would come into play potentially if your partner, like life insurance for you would come into play potentially if your partner needed to basically replace the things that you bring to the family in terms of economic value by paying someone else, right? And if that's the case, then there could be insurance. We could calculate a value for that and have insurance on your life. If not the case, then you may not need insurance, but your partner might.
That is key. I think you just mentioned a really great point. Some people might think that because someone is not earning any money or is not contributing financially, they might not need life insurance. But what you just said is even though one is the breadwinner, there still may be some need here. If, let's say, I would pass away, how would she be able to pay someone? Again, depending on the financial stability here, but she would have to, again, hire a helper or caretaker for, again, maybe the next 5 years to, help out with family situation.
I think in different situations, it could be different, right? Like a 15-year-old should be able to be pretty independent at home. But at the same time, it's like you also look at kids with special needs, right? Where where one person needs to stay at home because if they're, let's say, disabled on the autism spectrum, something like that, where they have high needs and they're needing a primary caregiver 24/7. And you've chosen to stay at home because your wife's business is doing well, but there's always going to be a need for someone to be at home. Well, then the conversation changes. And so even because they may still need care after age 18. And so if all of a sudden we look at, okay, well, this is what your retirement needs going to be, plus you're going to have a dependent carried through retirement, all of a sudden the whole conversation changes.
Awesome. Okay. That makes sense. Last scenario, we fast forward to, we're 60 years old now. We worked with Millennial Wealth Advisors and they've laid out a wonderful retirement plan for us. Now we're entering retirement. We've accumulated about $2.5 million in investments, split, personally and within the corp. Mm-hmm. And we wish to give to charity. Mm-hmm. When we pass away, we want to leave as much as we can to our kids. Mm-hmm. What would be the need for insurance at this point, do you think?
Well, I think at this point, the need becomes a preference as to how you want to give money to your kids. And then we want to look at some tax planning tools as well. If there's money in the corporation, how does that money leave the corporation, right? If something were to happen to your wife and there's $2.5 million in the corporation, or if something were to happen to both of you and there's money left in the corporation, what's the tax bill going to be? What's the capital gain going to be inside the corporation on the money that's been growing in there? Then what's the dividend tax going to be to pull the money out of the corporation and payable to the estate, right? And so there's going to be potentially multiple layers of tax there. And so one thing we could look at, and hopefully, if we see this trending earlier, we get on top of this earlier. This is where potentially a permanent life insurance policy can come into play, where you essentially park some of the cash inside permanent insurance. And if you were to pass away, a portion of the death benefit gets paid out tax-free to the estate if something were to happen to both of you. And so that becomes a potential where you could get money out of the corporation a little bit more tax efficiently than just leaving it in, mutual fund or ETFs inside the corporation continuing to compound. So that's one thing. But if the plan is to draw all the funds out of the corporation over a long period of time, then essentially you're smoothing out your tax bill throughout retirement. And at life expectancy, you're not expecting to have any money left in the corporation. It's all going to be personal. Then we've got to look at, okay, well, what's your estate likely to be personally at that point in time? What's the tax bill going to be? Is there going to be enough liquidity to pay the tax bill and still meet those charitable donation desires, as well as having money to pass down to your kids? So that's another way of looking at it too. Then the only thing there I would say would be to hedge against the risk of early death and a huge tax bill coming either from your registered assets or your corporate assets. You could look at purchasing like a term 10 life insurance policy or term 20 life insurance policy at 60 to counteract against the large tax bill that's going to be owed if you were to pass away early. So you're kind of hedging that risk a little bit by paying, probably not super expensive premiums relative to what you're going to be earning in terms of retirement income, but it's going to be a cheaper way to hedge some of that risk of passing away early and owing a lot of taxes on corporate money and the RRSPs. So that's one way to look at it as well. That could be a need there, but that's probably the extent of it. Looking at some tax planning around the corporation and then looking at some, risk management around registered assets, all of a sudden all cashing in at once if both of you were to pass away in like the next 10 years.
That's well said. And also to minimize the tax liability, if both of them were to pass within the first 10 years, it's also looking at what we've mentioned in our previous episode around decumulation strategies. So what should you prioritize in order to maybe realize more taxes, within the 60 to 70 period in order to minimize the taxable income, I guess, throughout lifetime, maybe depleted accounts that are subject to taxes. And then, so that could be one way to do. It's all about, like you said, like preferences and exploring different scenarios, like what makes most sense in that case, right? Do you agree?
I agree completely. And I think as we're like going through this with clients, it's important to know that we're kind of very high level talking about what insurance need you might have. When we're going through this with clients, we're looking at the numbers. We're projecting forward the estate tax bill. We're projecting forward like the income plan for retirement. We're looking at all of these things to make sure that, hey, we're actually coming up with a solid number that's backed around evidence that makes a lot of sense. We're looking at different outcomes if you buy insurance, if you don't buy insurance, those types of things. And then we want to present it to the clients and say, hey, look, you can go with option A. Here's your likely outcome. Option B, here's your likely outcome. Option C. Which one would you prefer? And so sometimes it even comes down to the clients like, yeah, I think life insurance makes sense. I think it provides a little bit more certainty into the plan. I think that there's some components of it I like, so let's go with that. Others are like, you know what? I really just don't see the value in paying like $500-$600 a month in insurance premiums at retirement. So why don't we just like structure our assets correctly now? Follow through the decumulation plan. At worst, we get hit with a pretty big tax bill, but our kids still get $1 million+, and there can be a lot of worse things in life, right? So it's all about like kind of walking through the different scenarios with the clients and seeing what do you prefer here. But very rarely does permanent insurance come into the equation. Permanent insurance can come into the equation when there's corporations involved. If there's a lot of assets, if there's, you want to, let's say you're a balanced investor and you want some money and a little bit more tax preferential tax shelters growing inside of a corporation, that can come into play. But in terms of an investment vehicle, investments will always beat it out. Well, I shouldn't say always. Investments will have a much higher probability of beating it out. And so we should leave the investments to do the investment work and let the insurance do the risk management work.
Yeah. Last question for you. If we've identified a expected tax liability at death, would it be better to implement a permanent solution sooner than later, given how insurance is structured, premiums, and guaranteed payout? And what's your take on that?
Yeah, so if we've identified something that's very likely to happen, the earlier we can identify it, the better, because the cost of insurance is naturally going to be cheaper. But that's such an overgeneralized statement because you can go through a bunch of different types of insurance to structure it the way you want to do it. So for example, if you go with the 10-pay insurance policy, you're going to have a lot less of that money go towards the cash value than what's going to go to fund the insurance up front. Versus if you go to a pay to 100, a lot less of it's going to go to pay for the cost of insurance because you're actually going to pay for insurance for the next like 40, 50 years if you're paying for it to age 100. Man, it's a tough question to answer, but I would say normally, look, if we've identified the issue and the person has already maxed out their registered plans and there's a legitimate need for permanent life insurance, the earlier we can find it, the better. But often what that turns into is people saying, hey, you're 25 years old And if you keep this up, you're going to have $30 million by the time you're 70. And so I know you haven't even started to max out your TFSAs or RSPs, but why don't we just start planning for that so that we can, give you like all this permanent insurance? And they sell them like a permanent insurance plan for like $700-800 a month, 25, and that's just total garbage. And so it has to be suitable at the time, even if we've identified a need that is likely to come up, but they haven't maxed out TFSAs, RSPs yet. Do that first. That's normally our advice to people. Let's revisit this strategy in 3 or 4 years when we know that the investment side of your strategy has been optimized. In the meantime, again, if we want to be proactive here, we could get a term insurance policy that we can then convert into permanent if we want to like make sure that you're going to be guaranteeing your insurability long term.
Awesome. The takeaway here is that do not replace investments with insurance. They're two different solutions for different needs and different outcome. Insurance is mostly a preference depending on your values, your goals, your wishes. And be sure to have an objective and thorough evaluations, presentations around the need that you are about to purchase and the amount that you're about to purchase, sorry. So,
yeah.
And that the last thing I always say to clients as well is taxes are part of life, right? Two things that are guaranteed is death and taxes. And if you're not comfortable where you're approaching 50 or 60 years old to put $1,000 into a permanent policy, and you're okay with the fact that your estate will have to be paying a certain amount of taxes, that's just part of life. But it also means that you've done extremely well throughout your life. Because if you have a very little estate, you will pay very little taxes. And if you have a large estate, then yeah, you'll pay more taxes than if you had a smaller one. So it's just part of life and depends on your preferences. There are optimal scenarios and we try to come up as close to it as possible, but there's a lot of factors that goes into it as you probably, as we covered in this episode.
Yeah.
Any last thoughts here?
No, it's a great episode. I guess one last thought would be stay away from MLMs when buying life insurance. Okay. So you're going to get approached. Almost every client we've talked to has gotten approached by agents of certain companies over the course of time. And I literally just saw a post about it this morning where someone said, like, if you go to someone for a financial review and they try to hire you, then run away. And so, because that's a multi-level marketing scheme, not a financial company. So what you have to make sure of is when you're getting insurance assessments done, there's a lot of multi-level marketers out there that will essentially do one of two things. Number one, they're going to try to sell you permanent life insurance because it's the only thing they can sell, right? In terms of like, they can't provide alternative investment products aside from like maybe segregated funds. So they're going to try to sell you permanent life insurance. Regardless of where you're at, it's going to be an all-in-one tool. Just ignore that. And the second thing they might try to do is hire you. So ignore that. So like, you just have to be careful because those companies have the largest sales forces out there. So you're going to come in contact with those people. Look, not everyone that works there is bad. Not everyone that works there is not skilled. Okay. But what you have to avoid is the idea that insurance can be sold as a concept, like an insured retirement plan or infinite banking or something like that. That's garbage. Okay. You've got to look at it from, what do I need? What do the numbers say I need? And obviously there's an emotional side to this. You can't ignore that. What do I want? Right? And make sure that the advice you're getting is from someone who presents both alternatives in an objective way. Option A, you buy insurance. Option B, you don't buy insurance. Okay. Especially when it comes to permanent insurance. If you don't have the two scenarios presented in an objective way, and it's important that it's objective because I kid you not, I've worked with the insurance industry for years. These companies all have simulations and softwares that will make it look like it's objective, but it's not. So the insurance company is actually the one doing the simulation and showing why it's better to buy insurance versus invest. Okay. So you have to be very careful. You have to potentially get a second opinion if you feel something's off, and you have to work with someone that you trust that you know is actually an expert in their field, or someone that brings in legitimate experts. Like for us, I've been doing insurance since 2016, almost 10 years, right? I've done permanent life insurance, critical illness, disability insurance. I've sold hundreds and hundreds of cases over the past 10 years, probably almost close to 1,000 now at this point.
Wow.
I bring in a third-party expert for more advanced complex cases. So when it comes to the person that you're working with and those types of things, You just need to make sure you get expertise on the topic, especially with permanent insurance. Term insurance is a little bit more like, hey, we can probably work with just like a regular advisor with this stuff. But when it comes to permanent insurance, you need to make sure you're getting the advanced expertise. So that was a little long-winded, but that's my last thoughts.
Well said.
Yeah.
Well said. Awesome. Thank you for listening. If you listen all the way to the end, make sure to either leave a comment, give us a review or a rating. If you're on Spotify, you just have to click the stars. Make sure you visit us at mwadvisors.ca. If you want to learn more about our services, book an intro meeting, subscribe to our newsletter, or just get in touch. You can also follow us on social. All the links are down below. And thank you for listening, and see you in the next episode.